What is going on with this stock market? How did Powell pull a 0.5 rate cut out of his magician's hat? Why is suddenly everything all sunshine and roses? Well, there's four major things that happen, and I'm going to go over those. I'm going to tell you what stocks I've invested in, and hey, I'm even buying bond funds because as interest rates go down, bonds go up, and I think I've picked the best bond funds for me. The story starts out with Tuesday. Retail sales, something we've seldom paid any attention to. Right now, any economic news is major news, and good news is good news, and bad news is bad news. But we acted like retail sales was the most important figure we would ever hear about from the stock market in our lives. And it's because we're on the lookout for recession. The Federal Reserve fears recession much more than it fears inflation. Inflation is bad. Recession is the worst. Retail sales on Tuesday morning came out positive for the month, 0.1%. Now, it previously was 1.1%, so it was a decrease, but it was thought that it would actually be negative. And oh no, here comes Mr. Recession. The fact that it eked out a positive number of 0.1% was massively positive. And then later in the day, we got word that the Atlanta Fed was predicting a 3% GDP, gross domestic product, which indicates that recession is nowhere near, at least for right now. So going into Wednesday, Jerome Powell was feeling pretty good. We got a Federal Reserve that's on the edge, looking for recession and not fearing inflation because oil prices are down into the 60s or the low 70s. So it looks like inflation's going to continue to go down. And the main thing is he's worried about it going down too much, indicating that a recession is coming on. So even though we got word from Nikki Leaks that he probably was going to cut 0.5, it still was a major relief to the stock market. But, you know, these algorithms and artificial intelligence has been programmed through the years that, oh, if you get a 0.5 cut, that indicates that things are on the edge. The only reason the Fed would do that is because things are on the edge and they're going to go bad. So I think it was actually artificial intelligence and the algorithms that trade the stock market that made the market go down slightly on Wednesday. But then Thursday, we got word that Jerome Powell wasn't exactly lying. The joblessness claims number came in at 219,000 when it previously was 231,000. So we got a lower jobless number, which indicates not necessarily that jobs are being added, but at least the people that have jobs aren't losing their jobs as much as they were. And so this was like a powder keg to the stock market, and the stock market took off royally, and there was fireworks galore, and everything went to the moon. Even technology, which is supposed to not benefit from lowering interest rates, even technology benefited somewhat. Two of my major technology investments are Nvidia and Oracle. And Oracle, because it buys as many Nvidia chips as it possibly can get its hands on, and apparently is benefiting strongly. Nvidia has been struggling. I struggle with whether to keep on keeping on with it, but it repaired some of the damage and was only down 1% for the week. Meanwhile, Oracle, which I plan to hold, is making 3.8% in the last week, in the last 5 days. Nvidia's relative strength of 37 is on the weak side and is indicative of its struggles. My next two technology stocks are a play on stocks that are being added to the S&P 500. Stocks almost invariably go up after they are added to the S&P 500 because the index fund managers are forced to buy them. And the two stocks that are being added are Dell Technologies, symbol DELL, and Palantir, symbol PLTR. And you can see, looking at the chart, that they have both gone up over 5% or more. Palantir has gone up slightly more. It's gone up 5.4%, while Dell has gone up 5%. But they're both doing well, and Dell's relative strength of 48 is okay. Dell and Palantir will be added to the S&P 500 on September 23rd. And then there is my favorite safe stock, Berkshire Hathaway. I do the BRKB shares, and it's gone up almost 2% in the last week. Its relative strength is 47, which is okay. 45% of Berkshire Hathaway is in cash. So I think at some point when Warren Buffett passes away, that somebody's going to have a buying party. I had to buy IWM, which is the iShares Russell 2000 ETF. And this is Tom Lee's wet dream that it was always going to just shoot to the moon. And finally, we got some minor takeoff as it's gone up almost 6% in the last 5 days. And I had to jump on it. Its relative strength is 55, which indicates that there's a ways to go on this, and maybe it will go to the moon. Buying IWM is a play on betting that small stocks are going to go up significantly. With interest rates going lower, I think home builders will do well, and so I'm doing the S&P Home Builders ETF, symbol XHB. And it's gone up over 8% in the last 5 days and has a relative strength of 64, which is good. I think we're going to be lowering interest rates for the next year, and there's a shortage of housing, so I think this should do well. You know, I've gotten addicted to the 5% interest rate, but I had my treasuries come to maturity, and I had to go into some bond funds to get the yield I was looking for. Looking at this chart, what you see is the high yield growth fund, which is corporate bonds, symbol HYG, and its net asset value has gone up 1%, but that's not the main reason I'm investing in it. I mean, 1% in 5 days for a bond fund is outrageously good, okay? And it's doing that because interest rates are going down. But its dividend yield is currently 5.82%, and that's where you really make the money on this. So you get the net asset value going up 1%, you get a dividend yield of 5.82%, and I also bought a high income fund, a junk fund as it's known, and its symbol is JNK. And you can see the net asset value on both of these funds have gone up almost identically. JNK has gone up 0.93% in its net asset value, but it pays a 6.43 dividend yield. And I'm buying this mainly for the dividend yield, but hey, you get a little net asset value thrown in too, so it satisfies my addiction to higher interest rates. And 6.43% on a junk bond fund like JNK is very good. I've put almost 1.3 million split between these two funds. So it's a significant investment, and I plan to keep it in there as long as interest rates are going down. I also put some cash into Fidelity's Bitcoin fund, whose symbol is FBTC, and my thought is I keep waiting for Bitcoin to make its run for 100,000. It's in the 60,000 somewhere. And it's been threatening to make a run for 100,000 forever, But I think with the price of gold finally going up, that maybe Bitcoin is going to catch fire because it is digital gold. So I put some money into the Fidelity Bitcoin Fund, FBTC. So the reason Powell lowered interest rates is because they're way too high. The neutral rate is around 3.5%. So the next two times, November and December, he's going to lower it 1/4 point each time for certain. The only thing is, if there's any weakness in the unemployment rate, if it goes up at all, if joblessness claims increase, he's going to do the 0.5 both times. Again, when they say they're data dependent, they're just data dependent whether they're going to lower 0.25 or 0.5. And if the data on employment comes out bad on either joblessness claims or on the unemployment rate, he's going to go 0.5 both times. That's the way I see it. That's the way I roll. Thank you.